Hello friends, welcome to this session on inflation and how it impacts our investments. So it's very important session to know. What we are going to cover in this session is first one would be what is inflation. Then the second part of this video would be why inflation is a problem to us. Third part would be why does inflation occur. Fourth part would be what is inflation rate in India and how is it measured. Fifth section would be impact of inflation on the purchasing power of money and investments. And the last part would be how to protect investment portfolio against inflation. So what are the options for that? So all these sections we are going to cover in this particular video. So let's start with what is inflation. So we will start with an example. Say suppose in the year 2000, the price of 1 liter milk was around 15 rupees. And what is the price of 1 liter milk in 2024? The price is 70 rupees. So this 15 to 70 is nothing but the inflation. So in simple terms, inflation is the rate of price increase over a given period of time. So inflation measures how much more expensive a set of goods and services has become over a certain period, usually a year. So every month actually they release the inflation numbers, but the comparison is compared to the last year same month. So that's the idea. So over the year they keep on releasing these inflation numbers. So now, why is inflation a problem to us? We are going to discuss about that. So here also we will start with an example, how inflation reduces the purchasing power. So because the same amount of money buys fewer goods and services as prices rise. For example, if you are buying bread, 100 rupees you are paying and you are getting around 10 loaves in that bread package. So rupees 10 per loaf. So you can buy 10 loaves for 100 rupees. But if inflation causes the price to rise to rupees 20 per loaf, then you can buy only 5 loaves. So that is the problem of inflation. So it decreases your purchasing power. And inflation factors that affect the cost of living, if we are going to discuss. So we have food inflation to take care of, we have fuel or transportation inflation, we have household utility inflation with us, we have medical inflation, we have education inflation. Whenever the inflation rates are on a higher side, RBI increases the repo rate. So effectively, whenever the repo rates goes up, so we will have to pay more interest on our home loans, vehicle loans, education loans. So it impacts everything. So ultimately, it has a very major impact on our finances, our budgets, and that's why inflation is an overall problem to us. So specifically, if we are inflation we are seeing. So what are the factors, or why does inflation occur? So there are two forces. Those two forces we are going to understand in this particular video also. So first force is cost push inflation, and the second one is demand pull inflation. So first understand what is the cost push inflation. So it occurs when production cost rises and producers pass on the increased cost to consumers. So effectively, whoever is the manufacturer of that particular end product. So if the raw material cost of that particular product increases, so then in that case, this producer or the manufacturer will increase the cost of that particular goods or services, and that is the cost push inflation. So it is the most visible inflationary force. Majorly rising commodity prices will affect into increase in the cost of basic goods and services. And one more example is higher oil prices. So we are net oil importing country. India is a net oil importing country, and whenever the oil prices goes up, there is a problem in the economy. Why? Because ultimately, if the crude oil prices goes up, we are net importers of crude oil. So effectively, we will have to pass on this particular rise on to the petrol and diesel prices. So effectively, then the transportation cost increases. So once the transportation cost is increasing, automatically the cost of those goods who are transported will also go up, and it will have an impact on our inflation. So I think this is the cost push inflation example, and normally it is not in our hand. Normally inflation is not in our hand, and that's why the governments are so worried about these things. Once the inflation monsters comes into your economy, it is very difficult to take out this monster, or take this monster out of your economy, so that, or out of your country. So that is the problem, and that's why governments are so serious. Central bankers are so serious. We are talking about nowadays about how central bankers are changing the interest rates. If the inflation goes up, they are increasing the interest rates. If the inflation goes down, they are decreasing the interest rates. So everything is linked to this inflation. Now the second force which drives the inflation is demand pull inflation. So normally it occurs when aggregate demand in an economy rises too quickly. So when does this particular thing happens? Whenever the disposable income increases. So whenever you have some extra surplus, extra cash available with you to spend, so at that point of time, demand for specific goods, demands for specific services will increase. So effectively, the increased demand will drive the prices of those products or goods or services on a higher side, and this will create an inflation. So this is a demand pull inflation. So overall demand outstrips the supply, the prices increases, and we see demand pull inflation. Now, what is the inflation rate in India and how is it measured? So, calculation of inflation. In India, inflation is measured using two matrices. So, first one is consumer price index inflation, and the second one is wholesale price index inflation. So, what is this consumer price index inflation? So, normally it is called as retail inflation. So, the CPI tracks the changes in the prices of a basket of goods and services commonly consumed by households. So commonly consumed by retail investors, retail spenders like you and me. So it reflects the cost of living and is used to measure retail inflation. Though in education inflation, medical inflation are at much higher inflation ranges than CPI inflation, but they are not considered in the CPI inflation calculation. So now what is exactly, if on in a simple terms, how to understand what is CPI inflation? The inflation which is affecting the households, or the inflation which is affecting the needs of the households, is called as retail inflation or consumer price index inflation. A lot of time you will see, so much of prices are increasing. Look at the movie ticket prices, they are increasing so high. Whenever you are going to malls, the prices are going up. So no, these things will not be included in CPI inflation. Majorly, the basic costs, so like vegetables, food, and all those factors, so which are required for our day-to-day living, which are necessities, which are needs to survive or live. So those are included in CPI inflation. So that's what we need to focus. A lot of time people confuse their want-based inflations with the need-based inflations, and government is not declaring our want-based inflations because it will vary for different people depending on their standard of living. So that also we need to understand over here. Now, the next inflation is WPI inflation. So WPI inflation measures the changes in the price of goods at the wholesale level, so before they reach to consumers. So ultimately, so it's a precursor to retail inflation. So whenever the WPI inflation numbers goes down, so automatically the retail inflation numbers will follow them. If the WPI inflation numbers are on a higher side, so retail inflation will follow them. So normally around 1 to 3 months of lag is there, and that's when we see the trends following. So it includes various commodities. WPI inflation includes various commodities and is used to gauge the overall price changes in the economy. So I think on the wholesale part, so the simple difference is one is retail inflation, that is CPI inflation, and the wholesale inflation, wholesale price index inflation is the WPI inflation. So that's the basic difference between these two inflations. So what are the inflation rates though in India? Average CPI inflation rates, I think you must be seeing that on the screen also. So in 2013, the retail inflation, CPI inflation was 10.02%. Then in 2014, it went down to 6.67%, then 4.91%. Then it went down to 3.33% also in 2017. And from then, a little upward journey has started in the year 2020. The inflation went up to 6.62% also. In 2021, it is at 5.13%. Then 2022, it is 6.7%. Then slowly it is coming down, but during that phase we have seen a lot of uncertainties in the global economy also. The crude oil prices going up because of that. Overall, the kind of money printing we have seen in COVID, so that also affected the inflation scenario in developed economies, and that's why their central bankers have increased the interest rates effectively with higher inflation in India also compared to the earlier levels, or the comfortable range of RBI, which is between 2 to 4%. So if the inflation is more than 4%, normally RBI increases the interest rates, and that's what we have seen, RBI also increasing the interest rates. And slowly, I think over the period, we will see the RBI cutting down the interest rates also. So the gist is, whenever the inflation goes up, the interest rates follow that. Whenever the inflation goes down, the interest rates also comes down. So that's the thing we need to understand. So why RBI does that? Because whenever inflation goes up, to kill the demand or to slow down the demand, so automatically the prices will come down. RBI increases the interest rates. So that's how whenever the interest rates goes up, the demand goes down and inflation comes down. So whenever the inflation comes down, so again revive the demand, RBI cuts the interest rates, though automatically the demand increases, and then prices also increases, and then the inflation comes back. So RBI's job is to manage this inflation in the comfortable range. So for RBI, the CPI inflation comfortable range is between 2 to 4%. If the inflation is between this range, RBI is comfortable. If it crosses 4% of inflation numbers, so then RBI automatically starts increasing the interest rates. So every 2 months RBI releases their policy, monetary policy, and there they decide about the repo rates, and effectively all our interest rates on deposits or loans will be linked to this particular repo rate. So now the impact of inflation on purchasing power of money. So say suppose we have heard a lot about compound interest and the power of compounding. So power of compounding is not only about investments. The power of compounding is on the value of money also. So say suppose in 2024 worth of 1 lakh rupees, 1 lakh rupees is there. So what is the future value of these 1 lakh if there is an 8% inflation? So in 5 years, if the rate of inflation is 8%, then 1 lakh rupees will be worth 65,908 rupees if there is a 8% inflation. In 2034, the value of 1 lakh will be around 43,439 rupees. In 2039, the value would be around 28,630, means after 15 years. And after 20 years, value of 1 lakh rupees will be 18,869 rupees if there is an 8% inflation. So overall, your 1 lakh rupees today will be worth 18,869 only after 20 years if inflation is considered to be 8% per annum. Since inflation eats your money in parts every year. So that's the problem of inflation. So therefore, what you can buy today for rupees 18,869 approximately, you will be paying rupees 1 lakh after 20 years if there is an inflation of 8%. So because its worth will reduce and will be left only 18,869 rupees. So how does inflation affect our investments? So while many people grasp the concept of compound interest, few truly understand the erosive impact of inflation on their money. So what compound interest builds? So what we have seen, the magic of compounding over the period, ultimately inflation erodes depending on the inflation rate. So the power of money is going down with the inflation number. So in a sense, inflation works in reverse. It acts like negative compound interest. Since inflation compounds year over year, its cumulative effect on investments mirrors compound interest and diminishes the value of money over time. So that's why we need to take care of this monster which is called inflation. The fundamental reason why investing is more important than just saving money is that the value of money saved would diminish diminish with time. So if your rate of interest on your savings is less than your inflation rate, then actually you are in a problem. You are losing money every year if your money is not earning more than the inflation. Hence, we must grow our investments so that our purchasing power can negate the effect of inflation. So what are the options to tackle this particular inflation? So we will talk about asset allocation or different asset classes. So example, let's talk about equity asset class. So what is equity? Ultimately, whenever we talk about equity, there are two numbers which come in front of us. One is Sensex, one is Nifty. So what are these indices? So there are different indices. Nifty, there are Nifty 100, Nifty 200, Nifty 500, Nifty mid cap, Nifty small cap. So there are different indices. So we will understand this particular concept of this asset class on a broader side. Say example, your real GDP growth is around 6 to 7%. Your retail inflation is around 4 to 5%. You just add these two numbers. So then you will get real growth, real GDP growth plus inflation numbers. That will give you nominal GDP growth. And that's what one can expect from equity asset class. So it means if your inflation is growing at 4-5% and your equity is growing at around your economy, nominal GDP growth is around 10 to 12%. So that is the rate of return one should expect from equity asset class over the longer horizon. On a monthly basis, yearly basis, there could be volatility, but over the longer horizon, equity will follow nominal GDP growth and the earnings growth of the companies which the index is representing. So that's why you need to have allocation into equity asset class. With that, you need to have allocation into debt asset class also, fixed income securities also. Depending on your risk profile, you can have allocation into real estate asset class also. You can have allocation into gold asset class also. So in equity, you can consider about equity mutual funds, index funds, direct stocks. In debt asset class also, you can consider about inflation linked bonds, floating rate bonds, short-term debt funds. In real estate, you can consider about real estate investment trusts also. In gold asset class, you can consider about gold funds, gold ETFs, or sovereign gold bonds are also, which are issued by Reserve Bank of India. So overall, in this particular session, we have covered the inflation and its impact on our investments also. I hope that you would find this particular session helpful, and stay tuned for the next session also. Let's meet in the next video. Thank you.